Welcome to Growth Investing Mastery. This video is going to look at stock screeners and finding new high-growth companies. As a reminder, this is not investment advice or recommendations to buy any stocks. The topics we'll look at in this video include an introduction on screeners, the main two screens that I use, how to reverse engineer a screen, and the ideal time to run a screener. We'll also look at some actual results coming back from a screen and how to evaluate financials quickly and effectively. We'll then take a look at financials and scenarios to avoid and the typical misuse of screeners. We'll also look at hot sectors and how to determine them through a screener. Then we'll gather actual results from the screener and look at how to use AI tools in the process. Lastly, we'll print and review transcripts to determine if we found a good company. The main objective of a screener is to find promising new growth companies, and we view a screener as mainly a brainstorming tool. Screeners are often misused by numbers-based investors, and we'll talk a little bit more about that misuse later on. The screener itself does not say whether to buy a company or to sell a company, and we prefer screens that are wider and take in more. We need a process to evaluate financials quickly and effectively, and our goal is to gather symbols that seem promising. Next, we can use AI to ramp up on the product that the company produces. We want to print the transcripts of the more promising names, and then review those transcripts to determine if the investment is viable. After reviewing the transcript, we'll decide whether we're going to invest or pass on this investment. And something to keep in mind, the universe of stocks is pretty small. There's roughly about 4,000 NASDAQ stocks and 4,000 stocks on the New York Stock Exchange. If we include international and maybe some pink sheet stocks, then we're up to about 10,000 viable stocks. And I think most people assume there's a whole lot more stocks being traded than that, so I wanted to point that out. I use primarily two main screens. The first screen looks at revenue growth with greater than 40%, and that's pretty much the only criteria, except for restricting some things about the exchange and the securities. The second screen looks for that same revenue growth of greater than 40%, and then adds in profitability. I check for profitability by measuring if EBITDA and net income are above zero for the current quarter. And the language to configure a screen like this may look a little bit complicated, as you can see below, but it's really just restricting the exchange and the stock types. And then I have a few more modified screens to look for things like international stocks and such. These screens below are from Koyfin, which is the main data tool I use, and it costs roughly $40 a month, so it's not too pricey, but it's basically like a mini Bloomberg terminal is how I've heard it pitched to me before. The screen for revenue growth has this universe criteria that the category contains equity, the trading region is United States and Canada, and primary security is set to yes. We need all that universe criteria so we don't let in things like Class B shares, which may have weird financials and such. My filter criteria first has market cap greater than 40 million, and this is just to disallow very tiny companies. And you could even bump that up to be like 500 million or such. Next is total revenues CAGR 1 year FQ between 40% and 10,000%. And that sounds super complicated, but it just means the year over year revenue growth is 40% or greater. Lastly, I have total revenues FQ is greater than 25 million. And this just means the latest quarter has more than 25 million of revenue, which is also to keep out like really tiny companies there. The second screen for revenue plus profitability is slightly more restrictive. And for the universe criteria, we have category contains equity. We have trading country contains US, primary security is set to yes, country contains US, and the exchange contains NYSE, NASDAQ CM, NASDAQ GM, and NASDAQ GS. So in plain language, this basically restricts to New York Stock Exchange, NASDAQ, and it's US based. And obviously you can tinker with this to make it international or allow in more if you want. For filter criteria, we add in profitability by checking that EBITDA is greater than zero and diluted net income is greater than zero. I like to check both EBITDA and net income because sometimes one-time tax issues can cause a problem. And EBITDA and net income are two of the most standard ways to measure profitability. Lastly, again, we have the revenue between 40% and 10,000%. I actually don't think you need the upper cap on the 10,000%, so you can probably just have revenue greater than 40% for that. I wanted to discuss reverse engineering a screen and what I mean by this term. First, we can examine our existing companies and try and figure out what financials do they have in common. For high growth investing and the companies I like, the 40% year-over-year revenue growth is the main criteria. I also prefer companies which are already profitable, but sometimes we want to get in on early companies which haven't turned a profit just yet. And the idea here is to create a screen which returns all the companies we own, but has the fewest names returned in the screen overall. And actually right now, all the companies I own do show up in that revenue and profitability screen, and it returns maybe 60 names, so it's fairly restrictive. But it's not a hard requirement that companies I own show up in this screen, it's more of a guideline. Sometimes companies can barely fall off the screen. For example, AppLovin reported 38% revenue growth year over year in one quarter, so it fell out of the screen, but that's definitely not a reason to sell if it's close enough to 40% revenue growth and we're happy with the quarter otherwise. Additionally, profitability could have dropped off in the quarter, and we want to listen to management to see what the reason is and if that makes sense to us to continue holding that stock. Let's discuss the ideal time to use a stock screener. One important consideration is that stock screener results only change when companies report new earnings and they get a new set of financials. And currently in May, companies are reporting Q1 of 2025. So we can get advance notice of promising companies that just reported really impressive results. So I like to check the screener more often during this time when companies are reporting, and this way I can find out of promising results coming through. After earnings season, there's about a month and a half where the list might get a bit stagnant and not updated for a while. So I'll use screeners a bit less when we're not in earnings season. I also like to use screeners more when we're short on new ideas or we're getting low on stocks. So if we have 6 or less stocks, I'll use a screener a lot more often to try and find a new stock. However, when I get above 11 stocks and I feel like I own too many companies, it makes more sense to do a bit more research on our existing companies and not try and keep pushing to find as many new companies. And one tip for using a stock screener is to sort by different criteria. And the default's usually market cap for sorting, but we can also sort by industry, alphabetical, and reversed. And sometimes just getting this fresh look at the sorting can help us find a new name. I also recommend tinkering with the parameters a lot, whether this is revenue growth, the minimum market cap, maybe adding international, and you can play around with it quite a bit. Here's some actual results from the revenue and profitability screen, and this shows about 15 names sorted by market cap. At the top we have NVIDIA, and NVIDIA is the only mega cap stock that's growing revenue above 40% and profitable right now. Also, 4 of my holdings are on this list, so we have AppLovin at number 3, Reddit, which is further down the list, and then Astera Labs and Hims & Hers Health are also on this list. And the list is a lot longer than this, maybe 60 names or so, but I just wanted to show the top names here. And one thing to keep in mind is that companies like Astera Labs and Hims, they didn't used to come through the revenue and profitability screen because earlier in their company journey, they weren't profitable yet, but they did show up in the greater than 40% revenue growth screen. So that's why I use the two screens together. To use a stock screener successfully, we need an effective and quick way to evaluate financials. So we may see a company coming back from the list that we haven't heard of, and we want to be able to evaluate this company to see if it's worthy of further research. I really like this default view in Koyfin, which includes revenue growth, EBITDA, net income, gross margin, and earnings per share. And the financials in this screenshot are from Sezzle with symbol SEZL, and that's a company I own. And this company demonstrates nearly ideal financials, so I wanted to start with viewing this company. One thing that really stands out with Sezzle's financials is the year-over-year revenue growth rate. Looking back over the last 5 quarters, it goes from 35% to 60% to 71% to 101%, and then to 123% on the latest quarter. So we can see that the revenue growth year over year is accelerating every quarter. Additionally, gross margin shows a really attractive trend as well. It goes from 51% to 58% to 63%, then jumps up huge to 69%, and then 71% in the latest quarter. Likewise, on metrics like EBITDA margin, we see a really impressive acceleration as well. It goes from 41% to 48%, 52%, 57%, and then 60% in the last quarter. So we can see that profitability is accelerating and revenue growth is accelerating. Those are two of the main criteria we really want to see for impressive financials. Let's take a look now at some financials to avoid. And this screenshot shows a typical example of a company we want to avoid. And I know this text is a little small, but revenue went from 494 million to 420, 439, and then 460 million. And then it had a huge jump up in the latest quarter to 838 million. So with revenue nearly doubling in the last quarter, it may look like this company might have had a new product that landed, or they have some new results, and it's really promising. However, the prior 4 quarters were nearly flat, and this is kind of a warning sign that there may have been an acquisition or a merger. I also included the market capitalization chart on the bottom, which shows that a few quarters ago, debt went from 566 million to 1.8 billion, so they added on quite a lot of debt. And then I used AI tools to query if this company did indeed have an acquisition. And that's what happened. So the company took on over $1 billion of debt to basically double the revenue. So it might be a good deal for them, but usually we don't want to invest in companies which are growing through acquisition, which may have previously been flat or don't have any organic growth. Let's take a look at some more financial scenarios to avoid. We want to avoid what I call lumpy financials. And this is where there's not a clear path of acceleration. So for this company, revenue went from 25 million to 77 million to 102 million, and then it had a big drop to 59 million. But on the latest quarter, it seems to have recovered and have gone up to 189 million. Additionally, in this latest quarter, both EBITDA and net income are pretty big. For 189 million of revenue, they got 72 million of EBITDA and 83 million of net income. However, when we look back at previous quarters, they have huge losses on EBITDA and net income. And these type of financials are almost always associated with a biotech company which had a product land. They may be recording all their reimbursements in one quarter or playing catch up on the financials somehow. And we're really looking for something a lot more consistent than this. We don't want to see a bunch of huge losses and then they have a big up quarter where there's some profitability. It's likely the losses may come back on future quarters. So we want to see a bit more consistency and not this lumpy pattern before we investigate more on a company like this. Let's now talk about the misuse of screeners. Screeners are often misused by investors who focus solely on numbers, and they use those to decide which investments to make. We want to use the screener as our starting point and not as the decider of which investment to make. I'll often see people who use screeners a lot. They get names from the screeners, and then they'll ask others to do the research on the companies. So they'll say, the screener spit out these 10 names. Are any of these 10 names good? And they might post that somewhere. The purpose of the screener is to do research ourselves, and we shouldn't be using the results to try and get others to do our research. Additionally, leaving off the narrative part or not reviewing the transcript is a critical mistake. And again, we simply can't rely on the screener to tell us if an investment is good or not. Sometimes people using a screener will make a screen way too tight, and they'll look to create a laundry list of items they want in an investment. So they might add stuff like the company has zero debt, that EBITDA is growing 40% per year, the cash flows are this, and add a bunch of metrics in there. The result ends up being hardly any stocks come through the screen, or maybe just one or two. So the screen isn't that effective when we use that laundry list style of ideals for a stock. Additionally, I'd add that sometimes it's challenging with the screener to find the metric we want. For example, year over year growth rate for revenue is often an obscure stat to find in the screener, even though it should be a lot easier to find. Finally, I'll add it's only been in the last few years that I started using a screener effectively. And part of my process was to reverse engineer that screen like we talked about and create a simple screen which allows a lot of companies to come through. Another pitfall to look out for when using a screener is sector rotations. Certain industries are cyclical, and they're likely to show up well in a screener for a quarter or two. That industry could be going through consolidation, and there's a lot of acquisitions, so revenue might be jumping up for a quarter. Additionally, the sector may just be hot in general, and all the companies are benefiting from some new regulation or something new about the sector. To give an example, currently, metals and mining and oil are hot right now. Metals is for a fairly obvious reason that the gold price has gone up. So if the gold price has gone up a lot, it's easy for those mining companies to get revenue growth of over 40% if the gold price went up so much. I'm not as sure why oil and gas are hot right now, but my theory is there's some consolidation in that industry and also some growth as well. Looking back 2 or 3 quarters ago, real estate, specifically REITs, were really hot and they were growing over 40% per year, and a lot of them were showing up on the list. Additionally, insurance companies were doing really well a few quarters ago, and there was over 20 insurance companies I saw that had over 40% revenue growth coming through the screen. What we can do with a screener is sort by industry to see this phenomena. It's really important we don't get fooled by a hot sector and select out a single company in that sector thinking this company is growing really well when it's really just all the companies in that sector are benefiting from some action. Here's an example of a hot sector right now. We sorted the screen by industry, and we see there's a lot coming through in the oil, gas, and consumable fuels sector. And this list is sorted by market cap descending. So at the top, we have a company called Enbridge, which is growing 68% year over year and has a market cap of 97 billion. And going down the list of market cap, we can see there's a whole lot of other companies growing faster than 40%. This isn't even the full list as well. There was more companies that were lower market cap in the oil and gas sector. So this lets us know that we want to be cautious about the oil and gas sector because it's really hot right now. Additionally, oil and gas isn't a sector which usually sees 40% year over year growth. So that's another reason to be cautious about this sector. Let's take a quick look at one more hot sector, which, as I mentioned, is metals and mining. There's even 5 companies on this list here that have revenue growth rate of over 100% year over year. And again, this is not the full exhaustive list of metals and mining. The list was longer, but it wouldn't fit on the screen here. Like I mentioned, sometimes the theory for why a sector is hot is really easy to explain. In this case, the gold price is up a lot, and most of these companies are mining gold. So they're getting more revenue because they can sell that gold for more. And again, we want to be real cautious about a sector like metals and mining, which doesn't typically see high growth, where all of a sudden it's now a high growth industry. That's usually a bit of a yellow or red flag for investment that a slow industry is now suddenly picking up. Although in some cases it could indicate an important trend we may want to try and observe. Let's talk about gathering results from an actual screen now. I recently went through the full list of my 2 screens, the revenue and profitability, and the screens yielded 10 symbols. I figured out the symbols to look at by checking out the financials for some of the companies. If the company had a really promising acceleration in its financials, whether through revenue or profitability, then I added them to the list to research more. I also put stars next to 2 of the names which seemed like they could be really promising. One hint that the company could be really promising is if they're in an industry which is typically a fast grower, like software or finance. And I had stars next to two names. One was Paysign with symbol PAYS. The other was Opera Limited, OPRA. So we'll typically prefer the names in the technology space over cyclical industries like metal and mining. The other companies that came through the screen which seemed promising included Tempus AI with symbol TEM, Transmedics, TMDX, Nova Limited, NVMI, and then Catalyst Pharmaceuticals, CPRX, Dave Inc. with symbol Dave, Monte Rosa Therapeutics with symbol GLUE, and then Power Solutions International with symbol PSIX, and also Propel Holdings, PRL. There were 5 names from the list that were already familiar companies. For example, I used to own Transmedics, which was a high confidence position before, and I was already meaning to review Transmedics transcript, but seeing it in the screener was just an added reminder. Additionally, previously I've reviewed Tempus AI, Nova, Dave Inc., and Propel Holdings. However, I reviewed those companies' previous quarters, and the companies still show up in the screen, meaning they've recorded another quarter of solid results at least. It's very useful to have reviewed a company before and know something about its product. This way we can jump in a bit faster to reviewing the latest earnings transcript. Let's now talk about using AI to query for product info about a company. Typically, I'll ask some basic questions such as where is the headquarters, when was the company founded, when was the IPO, and how many employees the company has. Now, some of these questions may seem very basic, like why do I want to know where the headquarters is? And that's because I've been burned before learning a company is headquarters in the Virgin Islands or Cayman Islands, something like this, or maybe Hong Kong. The founded date can let me know if a company is newer or was founded a long time ago. And often we can see if a company had some weird history, whether it was through a SPAC or how they became public. And here we can see when I was asking about the company Paysign, it was formerly called 3PEA International and then got rebranded or renamed. But all that rebranding and renaming happened in the late 90s, so I'm not too concerned about it currently. I like to check the IPO date to see if they did a traditional IPO or a SPAC or maybe they uplisted. I'll also ask about the number of employees. The reason for that is I don't want to invest in a company which has too many employees per revenue or has a ton of overhead for running their business. I'll usually ask a few rounds of follow-up questions as well. Those follow-up questions usually ask about the product the company produces. And then depending on the response I get from AI, I'll ask more questions. It can be really useful to ask such questions as break down revenue by geography or explain to me how this product works in depth. I really like this tool, Perplexity AI, which is featured here, because it gives you actual sources for the data, and then you can click on those sources and do additional research. Let's talk about printing and reviewing a earnings transcript once we have the list of symbols from our process. I like to add the notes I got from product details from asking AI on the back of the transcript. This way, all the details of the company stay in one place. An important part of the process is to look at the previous quarter guides and see where the company actually landed. So we can either review the CFO's statements on the previous quarter to see what the previous guide was, or we can go to the investor relations page and check out what they guided for. We really want to review the transcript with a discerning eye, and you can imagine you're on Shark Tank or as a VC investor learning about a company. And the main point is after you're done reading the transcript, you want to decide yes or no if you're going to invest. This is the same way a Shark Tank host or a VC investor would be forced to make a decision whether they're going to invest or not in a company. If we're really on the fence about a company and still not sure, we can add them to a watch list if needed. Sometimes this happens when we're really enthusiastic about one part of the business, but the company may have a glaring red flag that dissuades us from wanting to invest right now. It's fine to think it over before we invest, but we don't want to get FOMO checking the price all the time. And one good test to see if we should invest or not is if we will be upset if the stock goes up. If we never really believed in this company, then we shouldn't have any emotion around whether the stock goes up or not. But if we think this is a compelling investment and we don't make an investment, that's when we may get the FOMO checking the price of the stock. We can always start with a small position while we learn more, and it's okay to change our mind if we learn something new. In many cases, I bought a stock and then sold it a few days later after learning some new fact or detail about their business that I didn't like. If we're already really familiar with a product like Reddit or Nvidia, we can start a much bigger position than with a new company where we're much less familiar with the industry or product. I'll add that owning a small position acts like a forcing function to learn more. It makes me uncomfortable to own a position that I don't know enough about, so sometimes that small position will kind of light a fire under me to do more research. I also like to document on the back of the transcript whether I'm investing or not and what my reasons are. Probably over 95% of the time I'm passing on an investment, and I'll write those reasons down on the transcript. This way, if I come back to the investment a few quarters later, I can find that old transcript and see why I passed on it the first time. I can also review the product research I did on a previous pass on a company and see what I learned before. Let's now summarize what we've learned about stock screeners. Screeners can provide lots of ideas if used effectively. The keys to success are to use simple screens, evaluate financials effectively, and examine the product and narrative in depth through the earnings transcript. AI tools such as Perplexity can help speed up our process by asking questions about the product or basic information about the business. We want to avoid hot sectors which are cyclical. We also want to avoid common misuses of screeners. For example, we don't want our screen to be too tight and not give us enough companies. And we're looking to make a yes or no decision on investing after we review the earnings transcript. The ultimate goal of using a screener is the ability to rely on yourself. You can become self-sufficient in generating new growth stock ideas, and you won't need to rely on any recommendation services to provide you new ideas anymore. That concludes our video on stock screeners. If you enjoyed the video, leave me a comment or like below. As a reminder, this is not investment advice or recommendations to buy stocks. Thank you.